Hey there and welcome back to the channel. My name is Nate Gritzmacher, and if you have been watching my channel at all, sorry for the almost a year-long hiatus that I've taken from this channel. 2026, though, is the year that I'm committing to coming back starting February 1st and posting at least one long-form video every week in hopes to help you guys understand the mortgage process, your mortgage options, and overall just be so much more confident in the home buying process. So with that being said, let's get into the topic of today's video. Okay, in today's video, we are going to be going over the topic of pre-qualifications and affordability, and more specifically, a tool that I've actually put together that will allow you to play with this information yourself and see where you fall on qualifying or where you fall if you've set yourself a limit in terms of housing expenses. So inevitably, when I have an initial phone call with somebody I've been connected with, this topic comes up and it would look something like this. Okay, this conversation's been great. What can I technically qualify for, Nathan? And I would then start asking you for information like your annual income. If you're a salaried employee, that's a pretty easy number to come up with. If you're self-employed, that's typically just your taxable income amount for the last 2 years. If you make overtime or you have other variable types of income like commissions and bonuses, it gets a little trickier, okay? And then we'll ask you for information about your liquid assets that you intend to use for your down payment and closing costs, and then we'll ask you for your monthly liabilities. So auto loans, credit card minimum payments, student loans, child support, et cetera, et cetera. Basically, if you owe it to another individual or a creditor, you need to factor that information in. And then we just reverse engineer it based on the threshold set for conventional mortgages and FHA, VA, USDA, you name it. They have what are called debt to income ratio thresholds. So a conventional loan, for example, is 50%. That means you cannot exceed 50% of your monthly gross income with all of your monthly obligations. So if you make $120,000 a year or $10,000 per month, you cannot exceed in total liabilities between your mortgage payments, so your principal, interest, taxes, and insurance, as well as any other loans you have like auto loans, credit card payments, student loans. You cannot exceed $5,000 per month between all of that. So we essentially get all of that information and we reverse engineer it to tell you what you could in theory qualify for. Now, getting qualified over the phone obviously has some caveats. You're verbally stating information. You could be correct down to the penny. Great. We don't know that. You could be really overstating things or understating things and therefore getting pre-qualified for far more than you technically can purchase or far less than you may be able to technically purchase. So a pre-approval is definitely the ultimate route to take in terms of obtaining concrete information and very specific numbers. Now, that being said, pre-qualifications have their place. They're very helpful in kind of determining where you fall. That is what this tool that I'm about to show you that I've created really helps with. So let's jump right into this and get some more information. So we just discussed being limited by your total debt to income ratio, right? At 50%. I would typically advise that you not focus on your total pre-qualification or pre-approval amount, but more so something that you have set in place for yourself as kind of a limit or a goal that you'd like to remain under in terms of how much you spend on housing per month, okay? Just a very strong recommendation that I have. Do not buy at the top of your pre-approved amount or your pre-qualification amount because you are going to be putting yourself in quite a pinch monthly and on your lifestyle, okay? So let's just run a scenario with this calculator really quick. Let's say you are an individual applying for a mortgage and you make $120,000 a year, so $10,000 per month. You do not have a co-borrower. We're going to put 0 in here. Conventional mortgage is what you're aiming for. You have a 760 plus FICO credit score. This drop down right here is going to ultimately affect this mortgage insurance number over here. Okay, these are pretty conservative numbers. That's the goal here. Want to set the expectations fairly well. That way, when you actually go get pre-approved, you're not caught with a huge surprise if you actually did put all of this information in here correctly. Okay, so keep in mind that that mortgage insurance is a conservative number based on your credit score and your down payment. So let's just say you want to do 10% down. And today's interest rate is at 6.25%. You can do a quick Google search if you want. I'd add 0.125 or 0.25% onto whatever it's recommending just to stay on the safer side. If you just do a quick Google search with your credit score and down payment, you might get something that's fairly close. If you're talking to a mortgage advisor, just get today's par rate from them. So ask them what the lowest rate you can get is with no additional discount points or other fees associated with it, and put that in here. Property taxes. This you will want to do some research on. This will vary wildly between states, counties, cities, etc. So do some research on whatever county you are planning to buy in. Go to the assessor's website, dig around, get some information. If you're in Texas, this could be as high as 2.5%. If you're in California, 1.25% is generally pretty good unless you're buying a newer home that has mellow roofs or a brand new home that has mellow roofs. But that's a whole nother video that I'll get into. But we'll just leave that at 1.25% here. Insurance, same thing. Do some research, get some rough numbers, get some quotes if you really want to. If you're in a high flood risk area or high fire risk, this could exceed $200. This could be $300. This could be $400 per month. If you're not, this could be as low as $100. It could be as low as $80. That's just going to depend on where you're buying. If you are talking to a mortgage advisor, again, just ask them where, what these numbers will be based on where you're trying to buy. They should be able to get you some pretty good numbers. HOA dues. If you're buying in an HOA, good on you. Couldn't do it myself, but if you are, keep the HOA monthly dues in mind and plug them into here. That will certainly impact your qualification. Let's just stick with a standard 30-year term. Obviously, the lower you go with your mortgage term, the higher the monthly principal and interest, therefore impacting your ultimate qualification. So again, let's just say you make $120,000 per year and you've set a limit for yourself. You don't care about what you can technically get pre-approved for or qualified to. You have looked at your budget, you've set some expectations for yourself, and you do not want to exceed 30% of your monthly gross income. So $30,000 per month. You don't want to exceed that with your housing, okay? Your principal, interest, your taxes, insurance, and your HOA dues. You do not want to exceed $3,000. That's just what you've come up with when budgeting. This is going to ultimately set that threshold for you, and it's going to tell you, okay, based on your limit of $3,000 per month and 10% down, you need to purchase at we'll just call it $415,000. Now, obviously, if you want to stay within 30% and you want to target a higher purchase price, your options here are only save more money and put more down, or work on earning more money. Those are really your only two solutions there, since you've effectively just limited yourself to just your housing right here. And this will tell you down here, hey, you've limited yourself just by selecting your max housing debt to income ratio. Okay. So let's just say $415,000 is just not going to do it for you in your market, and you're in a little bit more of a pinch, and you really have to focus on spending closer to 42% of your household income to get you a house that you really want. This is going to change things. Okay, so let's also go down here. This is where we need to talk about the monthly liabilities that you have. Let's just say that you have $1,000 in auto loans, and you have $300 in student loans, and you have, we'll just zero out the credit card minimums to make this a little easier. You are now meeting the threshold of a conventional mortgage. You cannot, like I said earlier, you cannot exceed 50% total debt to income ratio on a conventional mortgage. That means that your combined monthly payments on all of this plus your mortgage payment cannot exceed, in this case, $5,000 per month, which is 50% of the $10,000 you earn in gross monthly income. So then you work backwards from there. You pull out $1,300, and that leaves you with $3,700 per month to go obtain in the form of a mortgage. And now what does $3,700 per month get you in your market? $518,000, right? So now we're being limited by the total back end ratio and not just the housing ratio that you set for yourself. Okay, you need to spend 42% per month, but you can't. That would be $4,200 a month, but you can't because you're being limited by these liabilities down here. Now, this is where it gets a little more useful for people that have debt and they really want to target things to pay off, because you can come in here and you can say, okay, I have an auto loan that's really near the end of its life. Maybe there's only $7,000 left to pay this off. I have that. I want to increase my purchase power significantly. So I'm going to go ahead and do that, pay off one of my auto loans. And now all you have is $400 per month in auto loans. We see this purchase price go way up. Now you are in fact being limited by your housing debt to income ratio of 42% that you've set here, because that plus your monthly liabilities does not exceed the 50%. It actually comes out to be 49%. So your back end ratio is still within qualifying. And now we're focusing on 42% of your monthly gross income to get you the purchase price that you would need to remain under. So $592,000 per month if you're doing 10% down. So I hope that you find this useful. Again, this is just created so that you can kind of do a lot of this yourself, get some education with it. This will allow you to better understand how different liabilities and how different payoffs will ultimately affect your qualification. Take this with a grain of salt, because obviously you really need to be putting everything in here incredibly accurately to make sure that you are well within what you would actually be pre-approved for. So be very careful with it, but it is generally on the conservative side. Should be at least. It should be very conservative. So when you actually go get pre-approved, these numbers could be slightly higher. So that's the goal here. Again, I hope that you guys find this valuable. I don't think I mentioned this. This is available on my website, natelenz.com. I will link it in the description of this video, natelenz.com. There is a menu option at the top right that you should find the affordability calculator in, and that is what this tool is. So that being said, go visit it, have some fun with it, go plug it in, mess with it a little bit, kind of look at your budget. I would encourage you to actually look at your budget as well. Look at your finances, look where your money's going, look how much you have left over to spend for housing. And maybe look at what it would look like to limit yourself to that number per month that you would like to spend on housing. Again, don't focus on what you can get pre-approved for. If you are buying at the very top end of your pre-approval amount, you really are putting yourself in a situation where so much of your income is going towards housing, and your lifestyle may drastically have to change. So take a step back, look at your lifestyle, look at everything you spend money on. If you need a higher purchase price that you'd like to target, look at what you can give up per month. Make sure your lifestyle is going to change a little bit. Try to avoid going into debt for your lifestyle. Take a good hard look at all of this and use this tool. Hopefully this tool really, really helps you gear up for understanding how much you can afford and how much it's going to cost you. So if you like this video, please like and subscribe, and I will see you in the next video.